Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Welcome to 2026. It's been quite a week after an extended holiday break. I hope you're geared up for what we think will be a year of record-setting credit issuance, north of $2 trillion in public IG. I read that productivity is up, so I have no doubt that the market will easily digest whatever the market throws at it. Fasten your seatbelt. It's go time. This week, our three things are: 1. Economic tension. Underneath the Goldilocks data are a number of competing forces. 2. Fed decision-making. Changes are afoot. And 3. Trigger points. Where does risk reprice? All right, let's dig a bit deeper. Economic tension. So within what is shaping up to be a constructive year for risk assets is tension. Tension between growth and the costs of debt. Tension between growth and inflation. And tension between the forces of geopolitics disrupting the global order. That sounds like a lot of uncertainty. Well, really it's not, at least as far as markets are concerned. The problem is any one of these can bubble up into something more consequential over the course of 2026. The question then becomes, will any of these cause a sell-off in risk? Let's think about these one by one. So one of the engines of growth broadly since the outbreak of COVID 6 years ago has been debt-fueled stimulus, something that has taken U.S. public debt to GDP from 79% pre-pandemic to 106% today, with forecasts showing a steady march higher from here. Unsustainable is widely used to describe the trend, which brings us back to, at what point does the music stop? At what point do the effects of financing the debt burden, including debt service costs and crowding out effects, become a widely recognized drag on growth? Our view is that we're not there yet, but we're headed in that direction. Now, it goes without saying that magnitude matters and competing alternatives matter. Accordingly, while concern on growing debt and deficits is widely expressed at home and abroad, the 10-year Treasury yield has settled rather nicely into a 4 to 4.5% range. Financial conditions remain quite loose, and growth is tracking above potential. For now, the tension between growth and costs of debt is benign. What about growth versus inflation? Well, the seeds are there for a reversal of inflation pressure, which has been diminishing over the course of 2025 when stripping out the one-time hit of tariffs. Consider above potential economic growth, stimulus in the form of tax cuts and incentives coming from the big beautiful bill, and immigration limitations that potentially lead to wage pressure. Add to that the potential for the Fed to cut rates further. Now, the market seems sanguine about inflation sub 3% as the Fed's own projection doesn't see core PCE getting to target until the fourth quarter of 2028. But the sensitivity to inflation rising above 3% is a whole other story. As we've said many times, no one likes inflation, especially when it drifts away from target. On the geopolitical front, the global political and economic order is in the process of being redefined, where evolving national priorities are met with reactions from impacted jurisdictions and markets. Much of this is likely to fall into the noise category from the market's perspective, but the potential for geopolitics to be market moving in 2026 is heightened. All right, on to our second thing. Fed decision-making. So, for upwards of 40 years now, the Fed has made its rate decisions the same way. The chair canvasses FOMC voting members and orchestrates consensus. That's why there has been remarkably few dissents over that time frame among what are undoubtedly proud and fiercely independent economists. That's changing. With the end of Jay Powell's term, we would expect the Fed to operate more like the U.S. Supreme Court or the Bank of England, where voting members feel compelled to vote their conscience. On the surface, we applaud what we believe will be greater transparency. Does anyone actually believe there are essentially no dissents, that everyone is in agreement with the chair's view all the time? Of course not. And we've already got a taste of this with dissents creeping out in 2025 on both sides of recent FOMC decisions. Some would say, well, the chair has lost control of the FOMC. Really? Who cares? Let the voters' views be heard. What this does do is strengthen Fed independence. The president can install, with Senate approval, a chair whose view on rates is consistent with his own, but that by no means means he or she will have the votes to push across the chair's view. All of this could conceivably change on an upcoming Supreme Court ruling that will decide if the president is allowed to fire central bankers. This is the Lisa Cook case, the Fed governor who the president fired, allegedly for cause, only to have lower courts block her dismissal. Assuming for cause sticks as part of the ruling, a president would be prevented from making wholesale changes at the FOMC to suit his or her wishes. We do not see a material loss of Fed independence as something investors should worry about. All right, on to our third thing, risk triggers. So last week we ran through risks we saw out there in 2026, inflation, the labor market, debt and deficits, the pace of AI investment and outcomes, the health of the consumer, geopolitics. So lots of things to keep abreast of, but reiterating the point we made in our first thing, something would have to bubble up before it would cause risk to reprice. Well, that got us thinking about trigger points. What are the relevant thresholds these factors would have to cross for markets to rethink current valuation levels? Let's start with inflation. The market is braced for an uptick. Core CPI, or PCE, above 3% will require an explanation. Is it a one-time tariff impact? That would be okay, but anything else would be problematic and will likely keep the Fed on hold. The labor market is a complex picture at this moment. A slowing in the supply of and demand for labor, resulting in what Jay Powell says is a curious balance, is unfolding, influenced by immigration and automation trends. Still, the unemployment rate might just be the single best indicator we have. And on that front, the trend is not the market's friend, with the current rate at the highest level since 2021, but still well below the 30-year average of 5.5%. A further bounce higher to 4.8% might be tolerated by the market as long as productivity maintains its momentum, but watch out if forecasts start to threaten 5%. And are markets really comfortable with non-farm payroll growth sub 50,000, and that's before Jay Powell's adjustment of minus 60,000 jobs a month? All right, how about the 10-year Treasury? Well, safe to say that very few a year ago thought the 10-year would threaten to fall below 4% in 2025. The consensus at that time was 4.4%. The consensus view today for June 30th, 2026 and year-end 2026 yields are 4.2% and 4.1% respectively. Safe to say a move back above 4.5% would put investors on notice, and piercing 5% would be problematic. Now, for what it's worth, the latest Wall Street Journal survey of economists has only 2 of the roughly 70 surveyed believing the 10-year will touch 5% in 2026. Over on the corporate earnings front, achieving another year of double-digit growth for the S&P 500 is what's expected, driven by the Mag 7 continuing to deliver. The consensus estimate for that group in 26 is 23%, while the other 493 come in at a perfectly respectable 13%. Credit markets will remain well bid even if those growth rates are haircut by, say, 1/3, but anything worse than that would be problematic, as that would result in an equity market sell-off, which in turn would no doubt spill over into credit. So there you have it, 3 things in credit. 1, economic tension. Growth is concentrated and debt-fueled. That brings with it consequences and vulnerability. 2, Fed decision-making. Greater transparency is a good thing, but watch for the Supreme Court's Cook decision. And 3, trigger points. Among risk factors, inflation is the one most likely to hit a point of concern for credit investors in 2026. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.